1. The real reason 90% of traders fail. Usually when you make a major financial decision, you kind of expect cold, hard logic to be sitting comfortably in the driver's seat. Right, yeah. Like it's a deliberate exchange of value. You give yourself time to actually weigh the pros and the cons. Exactly. Think about buying a car. You check the mileage, you pull the vehicle history report, maybe cross-reference prices at like 3 different dealerships. You make a rational, calculated choice. You wouldn't just buy the first car you see because it looked fast. No, of course not. But then, and this is where it gets crazy, you step into the world of day trading. You're sitting at your desk, staring at a price chart, and suddenly, this massive green candle violently spikes upward, and your heart rate just immediately doubles. Oh, instantly. Your palms start to sweat, and before your rational brain can even process the underlying data, your finger just twitches, and you click buy. Yeah. And usually within like 3 seconds, that green candle reverses, the price plummets, and you are instantly losing money. It feels awful. I mean, it's the absolute definition of a psychological trap. It literally leaves you feeling like the market is this living entity that is personally out to get you. It is a tale as old as the markets themselves, honestly, and it happens to millions of people every single day. So welcome to this deep dive. Today, our mission is to decode those invisible forces that actually move the financial markets. We're going to focus specifically on gold, which you'll see represented on your trading charts as xauusd. Right. And we've pulled together this really fascinating stack of sources for you today, ranging from, dense institutional trading guides to deep psychological breakdowns of human behavior. 2. Understanding market psychology and smart money. Yeah, we are going to figure out the exact mechanics behind that adrenaline rush, how to overcome the biological urges of FOMO and loss aversion, and honestly, most importantly, how to spot gaps. Gaps are so crucial. They are the literal footprints massive institutions leave behind on the charts. The overarching goal here is just total clarity. Like even if you are a complete beginner and looking at a chart feels like staring at the matrix, by the end of this deep dive, you are going to understand professional smart money concepts. Yeah, we want you to stop seeing random jagged lines and start seeing the underlying human and institutional behaviors that are actually driving the price. 3. Why most traders fail. Biology over strategy. So let's start with the human element, because the sources we're looking at are pretty brutal about this. They note that nearly 90% of retail traders fail. 90%. Yeah, that's a massive number. And the crazy part is, they fail even when they are handed a mathematically profitable strategy. Like, that tells me this isn't a math problem. It's a biology problem. It is entirely biological. I mean, the human brain is practically hardwired to be terrible at trading. 4. FOMO, the first trap. And it really begins with FOMO. And the fear of missing out. Right. When you see that sudden aggressive price spike, your amygdala, which is the fear center of your brain, it just hijacks your logic. You feel this sheer panic that wealth is being generated right in front of you and you're being left behind. And it really doesn't help that social media is just pouring gasoline on that fire all day. Oh, absolutely not. You scroll through your feed, you see people posting screenshots of like massive 500% gains. And you feel this overwhelming pressure to jump into the market immediately, regardless of what your actual strategy says. 5. How institutions exploit retail traders. Yeah, but the sources point out something incredibly sinister about that FOMO. It's not just a personal weakness, it's actually a tool used by the big players. Wait, really? Like they use our FOMO against us? Oh, 100%. This is where we need to talk about market mechanics. Like, if a massive financial institution, say a global bank, wants to sell 100,000 ounces of gold at a premium price, they have a major logistical problem. Because they can't just click sell like we can. Exactly. If they do, they will crash the market and ruin their own profit margins. Because for every seller, there must be a buyer. So how do they find enough eager buyers to absorb all that gold? Oh wow, they create a trap. Yes, they manufacture the bait. They push the price up quickly, which triggers that biological FOMO and thousands of retail traders who are just watching their screens at home. And so, those retail traders rush in to buy the breakout. Right. Completely unaware that the institution is on the other side of those trades, just happily selling their massive position to them. In institutional terms, those panicked retail buyers are literally called exit liquidity. 6. Loss aversion, the silent killer. Exit liquidity. Man, that is a tough pill to swallow. Just realizing your panic is literally just liquidity for someone else's profit. It's brutal, but it's how the market functions. But FOMO is really only the entry trap, right? Once you're actually in a trade, a whole new psychological hurdle takes over, and that is loss aversion. Yeah. And I found this part of the research fascinating because it's so incredibly counterintuitive. It really is. So, loss aversion is this well-documented behavioral economics principle. It basically states that the psychological pain a human feels from losing $50 is a significantly more intense than the joy they feel from winning $50. Right. We are just programmed to avoid losses at almost any cost, which makes us do the exact opposite of what a successful trader needs to do. Like, if a trade goes against us and we start losing money, our brain refuses to accept the pain of that loss, so we don't close the trade. We just hold on to it, hoping and praying the market will magically turn around. Exactly. But if a trade is in profit, we get terrified that the market will take our tiny gain away, so we close it way too early. We basically hold our losers and cut our winners. And that biological urge just destroys accounts. 7. Herd mentality. I mean, it also completely explains herd behavior. How so? Well, instead of trusting your own data, the fear of being wrong in isolation pushes you to seek safety in the crowd. You start jumping into crowded, overhyped trades because you figure, well, if everyone else is doing it, it must be safe. 8. The only solution. Position sizing. Okay, so if my own brain is actively sabotaging me like this, how do I actually fix it? The sources point to position sizing as the ultimate cure, right? Yes, absolutely. The golden rule here is strictly risking only 1 to 2% of your total capital per trade, or, an amount you're entirely comfortable losing completely. Let me ask you this, though. Why is that specific math so magical? Like, what does risking 1% actually do to the brain? It fundamentally removes the existential threat. Like, if you have a $10,000 account and you risk $5,000 on a single trade, your brain perceives that as a literal life or death scenario. Right. The amygdala takes over. Exactly. You start sweating, logic vanishes. But if you only risk $100, which is 1%, your brain doesn't register it as a severe threat, so your heart rate stays calm. Yes. Your logical prefrontal cortex stays online, allowing you to actually analyze the chart rationally. That makes perfect sense. I mean, if you are risking money you need for rent, you aren't trading the market anymore. You're just managing your own anxiety. It's basically a casino at that point. It really is. Like, without a predefined stop loss and strict sizing, you might as well be pulling lever on a slot machine. It's the literal definition of gambling. Professional traders accept that losses are simply the overhead cost of running a trading business, much like a restaurant owner accepts the cost of buying ingredients. 9. Understanding gold. xauusd. Right. Okay. So we've established how human fear dictates our actions. Let's pivot and look at an asset that is practically the global monument to fear, which is gold. Yes, gold, or XAUUSD. Yeah, for the beginner looking at a platform, XAUUSD is simply the ticker symbol. It just represents the price of 1 single ounce of gold measured in US dollars. But treating it like just another stock chart is a huge mistake. Well, treating gold like a regular stock will get you crushed. Gold is macroeconomic barometer. It doesn't generate earnings and it doesn't pay a dividend yield. Right, just sits there. Exactly, because that its value is entirely relative to other global forces. 10. Gold and DXY relationship. Most notably, it moves inversely to the DXY. Let's define the DXY for a second. That is the US dollar index, which measures the strength of the dollar against a basket of other major foreign currencies like the euro and the yen. Correct. So if the US dollar is showing strength and the DXY is going up, it takes fewer dollars to buy an ounce of gold. So the XAUSD chart goes down. They act like a seesaw. Oh, I see. Furthermore, gold drops when interest rates rise. Like if a bank is offering a 5% guaranteed yield on a savings account, holding physical gold that pays you nothing becomes very unattractive to investors. 11. Gold as a safe haven, the lifeboat concept. But when things get ugly, that dynamic flips entirely. The sources use this incredible lifeboat analogy. Oh, I love this analogy. Right. Imagine the global economy is a giant cruise ship. When the seas are calm and the weather is beautiful, everyone is up on the deck putting their money into riskier assets like stocks or tech startups, having a great time. Exactly. But suddenly, a massive storm hits. Maybe inflation spirals out of control, or a major geopolitical conflict breaks out. That cruise ship starts taking on water. And fiat currencies, paper money that governments can just print endlessly, suddenly seem very, very fragile. Exactly. So what do the passengers do? They sprint for the lifeboats. Gold is the ultimate financial lifeboat. I mean, it has been a recognized store of value for thousands of years. And the more severe the global panic, the more valuable a seat in that lifeboat becomes, and the price of gold skyrockets. 12. When to trade gold. Kill zones. Because it is so hyper-reactive to global news and institutional panic, you can't just sit down at 9 p.m. on a Tuesday and expect to trade it effectively, can you? No, definitely not. The sources strictly outline what they call kill zones. You shouldn't trade gold all day. Let's break those down. For beginners, you have the Asian trading session, which runs roughly from 7 p.m. to 2 a.m. Eastern Time. Our sources say to generally avoid this if you are looking for major moves. Right. It's low volume, it's choppy, and it rarely sets the actual trend for the day. So, when should we trade? Well, the Asian session is essentially the market taking a breath. The real institutional volume, the billions of dollars, wakes up during the London session from roughly 3 a.m. to 11 a.m. Eastern. And then you get the most aggressive window of the day, which is the New York AM session from 8:30 a.m. to noon. For a few hours, London and New York are open at the exact same time. That overlap is the absolute peak of market liquidity. 13. What is a gap? Market imbalance. So, if we know when the massive banks are operating, how do we actually see them? I mean, they move too much money to hide. Right. We mentioned earlier that they leave footprints. Let's talk about the biggest footprint of all, the gap. Gaps are fascinating. To understand the gap, you first have to understand normal price delivery. Okay, lay it on me. Normal price movement is like an auctioneer slowly walking up the bids. $10, $11, $12. On a candlestick chart, the wicks of the candles overlap nicely. Every single price point was offered and agreed upon by buyers and sellers. So think of it like climbing a staircase, taking it one single step at a time. Every step gets stepped on. Exactly. But a gap? A gap is taking an elevator and skipping 5 floors completely. On the chart, it looks like a literal empty blank space between one candle and the next. The price just teleported. 14. Why gaps happen? Why does that happen mechanically? Like, why jump floors? It happens because of an instantaneous severe imbalance between supply and demand. Imagine that auction again. The bidding is at $10. Suddenly, someone bursts into the room, announces a massive economic crisis, and screams, "I will pay $50. Wow, okay. The price doesn't organically travel through $20, $30, or $40. The highest bidder was 10. The new lowest seller demands 50, and the market instantly reprices. The space between 10 and 50 is the gap. No trading occurred there. And what triggers that guy bursting into the room? Usually, it's major economic data dropping. Things like the CPI, which is the inflation report, or the NFP, which is the U.S. jobs report. Right. The second those numbers are released, algorithms process the data in milliseconds, pull all their old orders, and slap down new ones, way higher or way lower. 15. Weekend gaps and slippage risk. And there is a very specific dangerous variation of this called the weekend gap. Oh yes, the weekend gap. It's vital to understand the difference between crypto and traditional markets like forex and gold here. Like crypto, trades 24 hours a day, 7 days a week. It absorbs news in real time, constantly. But forex and commodities close on Friday evening and don't reopen until Sunday evening. But the real world obviously doesn't pause for the weekend. Presidents still give speeches on Saturdays. Conflicts can erupt on a Sunday morning. Exactly. So for 48 hours, real-world pressure is building up, but the market is frozen. When the bell rings and the market finally opens on Sunday evening, the price has to violently snap to catch up to the new reality. It creates a massive weekend gap, which introduces a terrifying concept called slippage. Yes, let's explain slippage. Let's say it's Friday, and you buy gold at $2,000. You do the responsible thing and set a stop loss at $1,990 to limit your risk. Then the market closes. Okay, following you. Over the weekend, terrible news breaks. When the market opens Sunday, the first available price is $1,950. Your stop loss doesn't trigger at your chosen price because that price simply did not exist while the market was open. It just jumped right over it. Right. Your broker executes your exit at the next available price, which is way lower, and you suffer a massive, unexpected loss. Slippage is the harsh reality of holding leveraged positions over a weekend closure. It is an unmanageable risk. 16. Not all gaps are the same. Now, if I am looking at a chart and I see an empty space where price jumped, are all those gaps identical? Because if a gap is just a gap, trading would be easy. Far from it. The sources identify 4 very distinct types of gaps. Misidentifying them is exactly how retail traders lose their capital. 17. Common gap, market, noise. Okay, what's the first one? The first is the common gap. These happen in sideways, quiet ranging markets. They are usually small. They happen on very low volume, and they're basically just background noise. I want to stop you right there and push back on the common gap. Sure, if it is literally just low volume background noise in a choppy market, why is it even in the textbooks? Like, why should I care about spotting something that doesn't signal a major move? That is a really crucial question. You care about the common gap specifically so you know what not to trade. Oh, I see. Capital preservation is half of trading. If you misidentify a common gap as the start of a massive trend and risk your money, you will get chopped to pieces in a sideways market. Recognizing it is just noise, gives you the discipline to sit on your hands and wait. 18. Breakaway gap, start of trend. Okay, knowing what to ignore is a strategy in itself. So what shouldn't I ignore? You absolutely cannot ignore the breakaway gap. This is the exact opposite of the common gap. A breakaway gap happens with explosive, massive volume. It aggressively rips out of a sideways consolidation zone and signals the violent birth of a brand new trend. 19. Runaway gap, trend continuation. Got it. Third on the list from the sources is the runaway gap. I imagine this is somewhat related to the breakaway. Yeah, they are cousins. While the breakaway starts the trend, the runaway gap happens right in the middle of it. If gold is already surging upward for 3 days and suddenly gaps up again on strong volume, that is a runaway gap. It confirms the trend is healthy and accelerating. 20. Exhaustion gap, trend, reversal, signal. And finally, we have the exhaustion gap. This one sounds like a trap. It is a massive trap. It happens at the very end of a long, exhausting trend, right? It's usually driven by latecomer retail traders who finally succumb to FOMO. They see the market has been going up all week. They panic buy. The price gaps up one last time, and then the smart money instantly sells into them, completely reversing the trend. 21. The biggest myth: all gaps must be filled. Which brings us to the most toxic myth in retail trading, the idea that all gaps must get filled. I've heard this one so many times. There is this pervasive rumor that if a gap occurs, the price absolutely has to return to that empty space to fill it eventually. So, a trader sees a massive breakaway gap pointing up, and they immediately bet against it, trying to short the market just because they blindly believe the price has to go back down to fill the empty space. Yeah. That sounds like stepping onto the tracks to stop a freight train with your bare hands. It is financial suicide. I mean, common gaps and exhaustion gaps often fill quickly, yes. But breakaway and runaway gaps, which are fueled by massive institutional volume, might not fill for months or even years. You cannot blindly trade a myth. You must look at the volume. 22. Fair value gap, FVG, smart money concept. Okay, so we've covered these massive chart-breaking gaps, but the sources also dive deep into smart money concepts, or SMC, which focuses on micro gaps that happen intraday on like a 5-minute or 15-minute chart. Right? Fair value gaps. Yes. Fair value gaps, or FVGs. Can you walk me through the actual mechanics of an FVG? Like simply for a beginner? Absolutely. A fair value gap is a very specific 3-candle pattern that highlights a micro imbalance in the market. It requires 3 consecutive candles. Candle number 1 establishes the starting point. Candle number 2 is the vital one. It is a massive long candle that surges in one direction. We call that displacement. Then, candle number 3 forms, but its wick does not reach back far enough to touch the wick of candle number 1. 23. Understanding FVG through analogy. So, I tried to picture this like a relay race. Candle 1 is the starting block. Candle 2 is a sprinter who blasts off the block so incredibly fast with so much displacement that his shoes literally fly off and are left behind on the track. I like that. And then candle 3 is the finish line. Because the sprinter moves so violently, there is now an empty stretch of track between the start and the finish where his shoes are just sitting there. That empty space is the fair value gap. 24. Why price returns to FVG. That is a brilliant way to visualize it. The empty space represents an area where price moves so violently that the market couldn't pair up buyers and sellers efficiently. The institutional algorithms essentially dropped a massive order, but only part of it got filled before the price ran away. And this explains the mechanism of why price so often returns to an FVG. The bank didn't mean to leave those orders behind. They still need to buy more gold at that specific price. Exactly. So, the market naturally gravitates back. It jogs back down the track to pick up the shoes, grabs those remaining orders, and then continues on its original path. Exactly. The institutions use these microgaps as magnets to finish their business. 25. Stop loss placement. Critical mistake. And understanding this completely changes how you place your stop loss. How so? Well, a beginner will spot an FEG and put their stop loss right inside the gap, thinking they are safe. But that guarantees you get stopped out. Because we just established the market has to jog back into the gap to pick up the remaining orders, it will retrace right into your stop loss. Right. You must place your stop loss safely behind the first candle of the pattern, entirely outside the gap, or, at the previous swing, high or low. You have to give the trade enough breathing room for the market to dip in, rebalance those orders, and bounce away. 26. Inverse fair value gap, IFVG. But let me challenge this, because nothing in trading is 100%. What happens if the bank changes its mind? Like, what if the market dips into that fair value gap, but instead of bouncing, it just crashes straight through the floor and closes below it? Does the pattern just vanish? It doesn't vanish. It actually evolves into an inverse fair value gap, or an IFEG. When price disrespects an FVG and closes completely through it, the institutional bias has fundamentally flipped. The psychology shifts from buying to selling. Oh, it's like standing on a trap door. You think it's a solid floor that will hold your weight. But the moment you crash through it, that exact same piece of wood is now above your head. What was acting as support has inverted to become resistance. That's exactly it. 27. How to trade IFVG, step by step. And the sources lay out a strict step-by-step process for trading this. First, you wait for the FVG to form. Second, you watch the price violently break right through it and close beyond it. Third, you acknowledge the zone has flipped from support to resistance. And fourth, you wait for the price to retest that new zone from the other side, and you enter your trade in the brand new direction. It really demands an incredible amount of patience. You aren't guessing what the institutions are going to do. You are waiting for them to show their hand, break the level, and then you are just quietly following their momentum on the retest. 28. Backtesting, the professional edge. Okay, so we have armed ourselves. We understand how to fight the biological panic of FOMO. We know xauusd is driven by global fear and traded in specific kill zones. We know how to tell a dangerous breakaway gap from a noisy common gap, and we understand the mechanics of fair value gaps. We've covered a lot. But if you take this new knowledge, open a brokerage account right now, and start throwing real money at the chart, you are going to lose it all. Oh, you will. Because knowing the theory is not a system, you must backtest. Backtesting is the unglamorous, tedious work that separates hobbyists from actual professionals. 29. Building a real trading system. You are looking at historical data to mathematically prove your edge. The sources outline a pretty clear roadmap for this. They emphasize defining clear rules first, like what timeframes are you using? Maybe you only look at the 1-hour chart for bias and the 5-minute chart for entry, right? And you use historical data like COMEX or MCX for gold to find the setups. You scan those old charts specifically looking for institutional footprints. You look for a liquidity sweep, which is when banks push the price down to trigger retail stop losses, followed by that massive displacement candle creating a gap. You evaluate it monthly. You calculate your win rate and your expectancy over 100 trades. If your system makes $3 for every $1 you risk, you realize you don't even need to win half your trades to be highly profitable, and you must use a demo account before risking a single real dollar. 30. Journaling, the most overlooked skill. But honestly, The most critical step the sources demand is journaling. You have to journal the setup, and you must journal your emotions. Honestly, that is the one step I would naturally want to skip. Most people do. If I am looking at hard data, win rates, and candlestick patterns, why do I care how I felt? Like, dear journal, I was tired today. Why does that matter? It matters because your spreadsheet of profits and losses only tells you what happened. It says you lost $50, but your emotional journal tells you why you made the mistake. When you review your journal, you might notice a pattern. Like every time you trade after a poor night's sleep, you enter trades early out of FOMO, before the candle actually closes. You aren't failing because your technical strategy is bad. You are failing because fatigue compromises your emotional control. 31. Final truth about trading. That brings this entire deep dive full circle. If your amygdala is hardwired to panic and your brain naturally wants to hold losers and sell winners, the best technical strategy in the world is totally useless unless you build a strict, emotionally aware system to override your own biology. Precisely, you were building a framework of discipline to protect your capital from yourself. 32. Final insight and reflection. This has been a masterclass. I mean, we have mapped out the entire journey from managing the primal fear of loss and using 1% position sizing to understanding why gold operates as the world's ultimate panic asset. Yeah, and decoding the charts too. Right. We broke down how news creates violent supply imbalances that result in gaps, the severe danger of holding forex over the weekend, and exactly how to trace institutional footprints using fair value gaps and inverse FVGs. And we grounded it all in the mandatory practice of backtesting and journaling. It is a profound shift in perspective. Yeah. Stop reacting to the flashing lights of the market, and you start actively hunting for the logical imbalances. 33. The future of trading, AI versus human behavior. But before we wrap up, I want to leave you with one final provocative thought to mull over. We just spend all this time learning to exploit fair value gaps, which fundamentally exist because human trading is inefficient. Institutions can't fill their massive orders instantly without leaving gaps. But we are entering an era of incredibly advanced algorithmic AI trading. These AIs can process global news, identify a gap, and execute millions of microtransactions in literal milliseconds. If algorithms become flawless at perfectly distributing liquidity, well, there eventually come a day where these inefficiencies are completely priced out. That's a scary thought for day traders. Will the gap simply cease to exist on our charts? Or will the raw, unpredictable nature of human panic, geopolitical shocks, and irrational fear ensure that the market always remains perfectly imperfect? I think as long as there is a human being somewhere reacting to a breaking news headline, there will always be a footprint of fear